Welcome to the Big Biz Show, featuring insight, analysis, and a lot of stuff that's none of your business.
Hold on. This is the Big Biz Show. I think it is their business.
Making the markets work for you. Here's the man with the plan, Sully.
Live from the Jump Television Studios in sunny San Diego, California. Big Biz Show's on there. I was just talking to Chase Wilsey there about what he and his father do at Wilsey Asset Management. Welcome to the radio audience first. We've been talking to the TV audience for the last 5 minutes. Biz Talk Radio Network, iHeartMedia, American Forces Radio Network, nationwide, coast to coast, and across the world. Thanks for joining us here. Chase, you were telling me about an event you're doing this weekend for Wilsey Asset Management. WilseyAssetManagement.com. Chase works with his father. Chase is our millennial investment expert. You don't just have millennial clients, though. You have clients of all ages, right?
That's correct. I'd like to try and help the millennials out as much as I can, but definitely like to work with other clients as well.
So what do you have this weekend? What's going on? Anything that our listeners and viewers around Southern California can participate in, or is it too late?
Unfortunately not. It is exclusively for our clients. It is not open to the public.
So you got to be one of his clients. So here's the deal. So become one of Chase's clients, and you can have access to him, right?
Correct. Yeah. Every quarter we do a financial update for our clients, so we kind of talk about what's going on with the economy, the real facts of the economy. Not, oh my gosh, all of this is all the emotional things. It's the factual evidence of what's going on, and we also talk about the different companies we hold in the portfolio, just to really ease people's emotions and really give them the numbers behind what we're seeing.
Okay. So having said that. The last time you did one of these, is it significantly different than the first time you did one of these things as far as where your holdings go and what you guys are doing?
No, because we have a buy and hold philosophy pretty much. I mean, our philosophy is if something becomes overvalued, that's when we'll sell out. And right now the market is kind of creeping towards that overvalued level, we believe, and we have a couple companies in the hold category is what we like to say. So, I mean, we have a couple close to sell, but it's still predominantly the same holdings that we held in the first quarter.
What and without tipping your hand a little bit, are there any sectors that are making you happy right now? And any sectors you're staying away from right now? I'm assuming oil's not a big play right this second for you.
We're actually pretty heavily invested in oil, heavily invested in the financials. Retail is really exciting us as well because, I mean, they've all been beat down because Amazon's going to come and steal everyone's lunch. We don't believe that's the case. We think these brick and mortar stores are actually improving their technology to increase their online sales. So we think there's some really good plays in retail right now.
If we, if you could take your crystal ball out for the rest of the year, because we're going into, believe it or not, third and fourth quarter coming up here. With third quarter earnings, fourth quarter is right around the corner here. What sectors are going to come strong? Obviously retail, but other than retail, anything that the analysts are saying in your organization that you're looking forward to? I mean, are we leaning towards technology? Is oil and gas going to make a comeback in your opinion? Any other? I mean, gold is on a 30% tear. Silver's 50% up this year.
Yeah, I mean we're very bullish on oil in the long term. I mean, it's tough to kind of
got to be, don't you?
Yeah, it's tough to give my prediction on the next quarter because that is such a short time frame. But it's pretty easy comps for these oil companies because last year was just such a brutal oil price level of $20 a barrel almost. So right now they're having easier comps, which should improve their earnings going forward.
Okay, so let's talk about what we were talking about with you today because. There was a couple issues that you had with things like bonds and nominal return versus real return, and so on. So what is the difference between a real return and a nominal return, and when would we hear someone say real return versus nominal return?
This is a really interesting subject to me. I think it's actually pretty funny. A nominal return is the real, not the real number, but the actual number you get in a return. So let's say you make 8%, that's what you get. The real return includes inflation, which is much more important because you got
to discount that return. Right?
Exactly. Inflation is the cost of living, so you have to make sure you're outpacing the cost of living. And a lot of times people are happier if they get a nominal return of 8%, even if inflation is 7%. So then the real return's 1%.
Right.
They're much happier with that.
So nominal is what that reads on the prospectus. Real return is minus inflation.
Exactly. So the real return,
expenses and load and everything else, depending on how you're invested, right?
Yeah. The real return is how much you're growing your wealth over time, and it is kind of funny though. People would rather have that higher nominal return than a higher real return because they don't understand the numbers.
You know, it's interesting that I don't see anymore. I don't hear anymore, and maybe you could say maybe these. I have not heard. You know, when you hear investment you see advertisements on television for investing. Okay. Fidelity Fund, Vanguard Fund, for example. You never hear words like no load, fund anymore. Are there since we're trading ETFs these days, are the loads gone on mutual funds, or is it just something that they're not focusing on anymore? I mean, are you familiar with any load funds? Load meaning fees, by the way.
Yeah. I mean, the Class A shares where it's front end loaded. There are back end loaded funds, and I know they're still out there. You got to be really careful.
You still hear about them as much anymore.
Oh, absolutely.
Because there's other investment vehicles now that weren't around when they started fund.
Yeah.
I mean, basically, you had a money manager that managed the fund. He got a fee. The firm got a fee, and that was the load. That was it.
Yeah.
Now there's more complicated. I don't want to call it derivative because these aren't derivatives, but there's more complicated products now.
Exactly.
That are hiding the fees inside somewhere else, I'm assuming.
Yeah, they're always going to make their money. You got to understand that they're not just doing business to do it for free.
Sure.
They need to make money.
Yeah.
You really have to read the prospectuses, and a lot of times people just have trust, which is
okay,
sometimes a burden.
So when we learned last time when Brent was on, your father was on the air with us, is that you are turning into a geek that loves to read 10Ks and 10Qs. A 10K is an annual report for a publicly traded company. 10Q is a quarterly report for a publicly traded company. You can go to edgar.gov. You can really dig into a company and look at their financials. Johnny Lunchbucket's not going to do that. But when you really need to read the prospectus, okay, first of all, that's like reading a mortgage contract.
Yeah.
I'm not going to sit. I mean, look, there's so many exculpatory clauses in there that are just protecting the brokerage firm that a lot of it's a waste of time. If you were to look at a prospectus and just open to the page where you know that you're going to look every time, what would you tell people to look at?
That's a tough question because I really don't deal with a lot of prospectuses.
Well, but when you tell clients to read the prospectus, what are you warning them against?
Yeah, well,
just buying and not being informed, for example.
I think the biggest thing you need to do is you really have to trust your financial advisor because I mean we don't deal with mutual funds. We don't believe in them
because of the load involved, right?
Because of the load and this idea of net redemptions. Now,
talk about that.
Net redemptions is mutual funds pull all of the money together. And when people panic and sell out, the fund manager has to sell out of positions to meet the cash that is required for the net redemption. So what that means is
that's a regulatory issue, by the way, that the SEC and FINRA put on them.
Yeah, but what that means is if someone holds true during this time frame and the fund manager had to sell out, let's say Apple, even though you held true, you lost equity in Apple.
So, okay, now, is that the same with an exchange-traded fund?
Exchange-traded funds work a little bit differently.
Do you guys believe in exchange-traded funds?
Basically,
they're baskets of stocks. And the idea was that it mitigates risk. That was the idea behind it originally.
Yeah, and we will use them occasionally as a hedge.
Like, for example, take a look at GLD, guys. If you gold's a good example. You know, gold is up to $1,365 an ounce right now. Its high back in 2011 was almost $1,900. It's taken a little bit of a pullback in the last couple of days, but GLD is a basket of gold stocks. There's a danger here versus just buying gold, is what you're saying. Because of the expenses involved and because of the net redemption issues involved, right?
I mean, yes, and this is a totally different issue for us, but we will not buy gold.
So no commodity like gold or silver, nothing like that.
No
precious metals.
No, our belief is gold is you can't put a value on it. You can value companies because you can value their sales, their earnings, their book value, their cash flow.
Right?
Gold is perception.
That's why you don't buy dollars.
It's a piece of metal. It's whatever the next person is willing to pay for it.
But will you buy municipal bond funds? Will you buy bonds at this point?
When the time is right.
Okay, so listen, my parents, who are in their 70s and 80s, would argue that that's all of their money's in bonds right now.
And I think that is one of the biggest mistakes people make.
Okay, so talk about that. For a 70 or 80-year-old too?
I believe so.
All right, tell us why. Tell us why you don't like bonds.
Wall Street just kind of has this perception that, you need to have asset allocation. You need to have bonds. And the thing I'm saying is, why do you need to have bonds? Right now, I was looking at the 10-year Treasury. It's at about 1.5%. Yeah. And going back to real returns, if we have inflation of 2.2%,
you're losing money.
You're losing 0.7%.
It's like putting money in your savings account at 1% at the bank.
Exactly.
By the time it's all over, you're gonna be broke.
Yeah, you're gonna be broke. Your real value of your money has gone down, and that doesn't include when interest rates do go back up. You're locked into a 10-year Treasury, or you're locked into a particular bond.
Or you're not gonna get a return.
Yeah, because what happens is when interest rates go up, bond prices go down, which means your return is even worse.
That's what I teased before I went to the break. There's an inverse relationship to interest rates and bonds. let's look at, when we come back from the break, I'm going to keep you here. I want to talk about how much cash should be in our portfolio, number one. Number two, I want to talk about TBT and TNT. Two bond funds. One is inverse bond fund and one's a bond fund. You're going to see exactly what he's talking about here because it's important. And also Brent Wilsey hopefully will be walking through the door here in just a second. We'll talk to him a little bit. And we've got a challenge athlete with us today from CAF, Challenge Athletes Foundation. We've been able to raise successfully over $100,000 over the last 6 years for Challenge Athletes Foundation. I got to hit up some of your clients. You got to hit up we got to hit your clients up for a donation. That's what we're going to do next. Coming up here on Big Biz Show. And then one of the things that Chase is going to talk to us about is how much cash you should have in your portfolio, because a lot of people think that, hey, let's go to cash now. Let's sit on the sidelines. He's going to tell you why that's a bad idea. Chase Wilsey Asset Management is our millennial investor, but he's just our investment expert today. There's their website, wilseyassetmanagement.com. If you're listening to us on the radio, I'll tweet that out and I'll put it on our website, bigbizshow.com. It is the Big Biz Show, Biz TV, Biz Talk Radio Network, iHeartMedia, American Forces Radio Network. Stand by.